All right, thanks everyone for joining us this evening. So we're starting very shortly. We already launched our Zoom and the YouTube live session already, right? So you can actually take a look if you wish to on the YouTube channel. All right, if those that are done with dinner, do also try to move to the front. There's more seats in front, closer to the screen as well. You can see clearer for the slides itself. Right, so for those that are online, if you want to ask any questions, do feel free to check and post the questions on the Q&A box itself, not the chat box, right? The Q&A box, and then we also have a Q&A session after myself. I'm Teo Huan Zi here. After my speech and also after Miss Jamie's speech, there will be a Q&A session where we will address questions from the floor as well as from online audience as well. Okay. So we'll start at around 7:01, so around 3 to 4 minutes more. So to let more people stream in, either through online or through the physical location. So do sit and relax a while. All right, thanks everyone for joining us this session this evening on Thursday. All right, so my name is Teo Huan Zi here. I'm the dealing manager for the Phillip Center team, for the dealing team, and also in charge of the education session itself. So today with us, other than myself, we'll be sharing on the Hong Kong stock market and outlook. We have Miss Jamie from Macquarie, Singapore. She will also share on some of the Macquarie warrants that can able to get exposure into the Hong Kong market, both for long or short, right, to hedge your position potentially as well. Right, so you can see on the screen right now, the first one they are flashing is basically the ongoing promotion that we have. It will end on 30th of June this year. All right, so basically you buy any one warrant trade above $3,000 by contract value, right? You qualify for $68 worth of cash credit to your account after the promotion period ends to credit to your account. So this is if you have not traded any warrants before. All right, based on the T&C, you can take a look in details later. But basically, you have not traded before, and after today on the Hong Kong session itself, and after you listen to how Jimmy shared on how warrants work, if you're interested to try out, then you have this promotion to incentivize you as well. Okay, so on top of that, to be specifically for Hong Kong stock warrants, you also have this coupon, all right? Basically, if you actually swipe it on the Poems 3.0 app, on the Poems 3.0, under the rewards tab, you can use one coin. This coin is actually free. You can get it on a daily login, daily task that you complete at the Poems 3 app, Poems Mobile 3. And after you exchange for the coupon, you can then redeem it. So the next trade that you do, you will then have $30 rebate credited to your account after the campaign ends as well. So 68, 30, total 98 if your trade on the warrants is on the Hong Kong stock warrant. If you trade on other Macquarie warrants, you will still qualify for the $68 promotion as well. But specifically for Hong Kong stock warrant, you will then also qualify for this coupon as well. Okay, just take note on this. But this one you must hold for at least one night for both the promotion for the warrant itself. So the buy contract above 3,000, hold for at least one night, and you will qualify for both promotion if you redeem the coupon as well. Okay, so without further ado, let me start with this Macquarie training, right? We have this then on the Hong Kong stock market outlook, right? The date of. Okay, so later on, any example that I'll be giving more for illustration purpose, not exactly a buy or sell instruction or call itself that I'm giving to you, but just my sharing on my personal opinion on certain stocks as well. Okay. So basically, let's recap, right, on the more recent performance of how Hang Seng Index have been moving or Hong Kong market. So you expect, you can recall and see in early April, right, early April, you see a very significant volatility due to what Donald Trump announced on tariff on across the various countries. Of course, they already have ongoing tensions between China and US, which I will mention later, timeline. Basically, there's escalation of volatility in early April, where it plunged 13.2% at one point, right, on April 7 itself. After April 7, it continued to drop for 2 more days until April 9, which was the lowest in terms of the trading day low. But the lowest closing for the Hang Seng recently will be on April 8. Right? April 9 traded lower, but it closed higher than April 8 closing itself. All right. So April 8 close is at 19,261. You compare that to currently today the closing around 23,400. That is around a 4,000 points rebound. And 4,000 point, if you compare to 19,000 at the point of time, that's going to be around a 25% recovery, 20-25% recovery from that point of time. All right. So, and the time frame is when? From April 8 to today. Today is just May 22nd. Right. So it's a very, very quick rebound they are seeing on Hong Kong market. So that's why I think you're also interested to listen to us why there is this volatility or this swing in performance. All right. So the drop is not only subject to Hang Seng Index, of course, right? Of course, you see Hang Seng Tech also dropped 17%. The CSI 300, which is the China, one of the indexes on the 300 top counters in China, also dropped 7%, even when China supported their own stock market through their state funds. All right. So if you compare to currently the rebound, right? So first thing, rebound from government support is one. All right. Another one is that there is also this 90 days tariff hiatus between China and US, which also supported the market. But do note is this, even though the US rebounded mainly from this 90 days hiatus, right? If you actually look at the chart later, which I will show you, for Hong Kong and China market, the rebound actually came even before the announcement on May 12th, right? Of course, the May 12th announcement helped to continue to spur the rally that Hong Kong and China market experienced in the recent few weeks, right? Okay, so the close as of 20th of May, which I prepared the slides, of course today there's some volatility from Wednesday and Thursday, but as of 20th of May, the close was at 23,700, that range, right? So it's a high since 27 March 2025. So basically it's a 2 months high, rebounded back to pre-impact of that particular announcement that Donald Trump made in April. All right. So most of the Chinese tech companies also reported positive results. Why I focus on tech companies? Because I will talk about the Hang Seng Tech Index as well. We will focus more on the stock picks that we are using today to showcase to you the performance is on the Hong Kong tech stocks, which I think is also more people are more interested in general if you're trading on the volatility as well. All right. So the leading Chinese tech names actually are trading at a forward PE averaging of 13 currently. So even with the rebound, it's still at 13, and it's going to be much lower than the global averages that you're seeing across the US and other developed countries as well. So this is the current situation that we're seeing. Right, so for economic health, let's recap very short one. Hong Kong itself currently around 2.4% in April, 2% in March, so slight increase. Right, tourism increased 13%. Okay, so they have increased 10% from 2024, right, in terms of the January to April period. Right, so there is a recovery of underlying economic factors that we are seeing in Hong Kong. Of course, they are also not just purely depending on domestic market, but also on the tourism market is one thing. Right. Next thing is that, however, even with the tourism and the numbers itself that we're seeing, that is relatively stable for Hong Kong, the business condition are continue to deteriorate, right, because of the challenges that it's facing on the private sector, not only because of the relationship between Hong Kong and China, but also because of the potential trade escalation again, trade tension escalation again after the 90 days is up. So we're not very sure, of course, that whether Trump will do anything in continuation of 90 days. But as of the most recent update that we know, you see that actually China is also doing some of their own trade controls. They also announced some of their trade restrictions on their end on certain sectors or on certain particular products as well. So even with the ongoing trade so-called titles on the overall blanket nature, China still have ongoing limitations on trade. So we do see potential escalations of trade issues going into after July, which is a 90 days ending period, right? The next thing we have is for inflation for China itself is actually at minus 0.1% year on year on April. So technically, if you consider that similar with March numbers, it's reflecting more of a deflationary pressure in China itself. Of course, China people, they might still see inflation in terms of their spending inside the country. But in general, as an economy per se, it's still a deflationary pressure. Right, tourism number is a sharp increase, right? But they are actually still very dependent on domestic tourism. And in terms of the actual spending itself, it might actually be dropping, even though there is an increase in tourist visits itself. And the PMI actually dropped below 50, at 49 for the month of April compared to 50.5 in the month of March. And that shows that contraction in the manufacturing sector, right? And also that also can be because of the trade tension at that point of time, right? Because April was the peak of the trade tensions in China itself. So we should see a recovery of that number, sharp recovery of numbers in May, since there was a 90 days period, and everyone might be rushing to push through all the different manufacturing and exports before any potential re-escalation of the trade tensions again in July. So May and June, you should see a very sharp increase, but might be a short-term thing as well. So do not take that recovery too much into account if you're reflecting on a more long-term trend for the Hong Kong and China stock market in terms of their economic performance. So this is the timeline, right? It's a bit long, but I'm putting it here so that you can also review when you are back using the YouTube live, right? That we have. Okay, so in February, of course, there's a starting of all these issues, right? Then 10% on China, 25% here on Mexico and Canada. Actually, this was already so-called delayed by Feb 4. They already delayed this. So ongoing, Feb 4 itself, you only see 10% on all China goods, right? Second one, Feb 10 itself, right? The China itself, after it affected, Trump also announced specifically on steel and aluminium 25%. Right? So this is a specific on them. So technically on steel and tariff and aluminium, they're going to be facing 35%. You would think of it that way, right? 10% plus 25%. Right? Then there's also reciprocal tariff on other nations that was announced, right? Then also they have additional 10% again on March. So by this time in March, it was at 20%. Right, good to note that along this way of Feb to March, around this point, right, Hong Kong and China stock market are still on the uptrend. It's still bullish. Recovery in the sense that there was still a shift of funds flowing from the Western world to back to Asian markets because of the whole AI and the whole tech scene recovery that we are seeing, spurred on by DeepSeek at the point of time. Right? So if you've been following the news since last year until now, there was a big switch of the funds flow going into Asian market due to the DeepSeek developments and also the other faith of other Chinese firms developing their AI powers and also their different technology firms, right? So if you continue, then China then retaliated at the point of time on March 10, right? They announced on March 4, but to start on March 10 itself for 10 to 15% tariff, right? So the effective tariff paid at this point of time on March 12 is 45%. As I mentioned, 20% that was here, the total 20%, plus 25% on steel and aluminium, right? Then if you go on again, on March 26, 25% was on automobile to effect on April itself and auto parts on May itself. And then for the package of tariff across all countries on May 2nd, on April 2nd, China one was to be increased to 34%, right? 10% was the universal rate that was applied across all countries first on April 5th, all right? And then the announcement of the more subjective reciprocal tariff on April 9th. Okay, and then directly, China, of course, reacted by announcing 34% tariff on all US goods effective on April 10th, which is actually one day after this, to see if Trump will actually implement any of this, how extensive this will be, right? So at the point of time, universal tariff of 10% effected on April 5th. It means that at this point of time, on April 5th itself, if you follow, it was March 4 at first, then now April 5th, 30% blanket tariff on all China goods. Right? So this is the second page. Then thereafter, of course, Trump threatened even higher tariff if China actually retaliated, right? Which China didn't really react to that. China still retaliated. And thus, Trump hit China with 84% additional tariff. This is hard to understand now. So later I'll have some graphics to showcase what happened. All right. So you see right now, right? China with 84% on all US goods. Trump is at least 145% blanket tariff on Chinese imports effectively. All right, that's a general thing. Then Trump also announced a pause on the tariff impact on other countries except for China at the point of time. And China, of course, reacted, increasing again, exempting only smartphone, computer, and other electronics back to 20% tariff, right? Due to the impact involved for those companies, right? Then China also rolled back some tariff on the semiconductor, which they really need for their own economy as well. And then thus, you see on May 6 itself, then they also agreed to meet. They announced to meet, right? Over the weekend, they of course, I think quite recently, last week, right? Monday itself. Actually, over the weekend last week, but Monday they announced everything, and then they agreed with the rollback for 90 days period of pause of this trade issue. But even with this pause, it's not saying China got no tariff, not zero, not go back to zero. Go back to where? About 30% and 10%. Okay, so if you see at the peak, April 9, this is Trump on China, right? Chinese good 145%. Steel and aluminium still 25%. Automobiles still 25%. So effectively, if you're looking at steel from China, is 170%. Automobile from China, 170%. Effectively, okay? Then China one, 11 of April, China one was 125% effectively after all the increase that they have made. Then for China on US, they have 3 additional categories, which is the coal and LNG, as well as the crude oil and agriculture machinery, as well as agriculture products. Okay, so these 3 categories, right? So it's different from what the 2 countries have different sectors. So this is to give you some idea, if you're looking at Hong Kong market, looking at China market, then which are some of the sectors that will be impacted more, right? Because of the correlation to the tariff impact to them itself. So as of May 12, right, of course, the tariff will roll back, right? So what they roll back to? Roll back to this. It's the current state, even till now, right? Until early July, where then they will then see if China and Trump can really reach any agreement for longer term, right? If not, it might go back to what we've shown just now. So it's not saying that this 90 days period is going to be all rosy, everything is clear, trading is all good for now, means that it will go on all the way. So there is still that innate potential that of escalation once again in July going forward. Well, we're not sure what Donald Trump and China will agree on. Okay. So what's the opportunity itself? So you're looking at manufacturing sector, right? So we're looking at different sectors now to see how you visualize opportunities for yourself. So you then have a direct substitution of the Chinese manufacturing to actually capture market share in the electronics, machinery, and consumer goods, which they were previously importing. So now they are less competitive by the US side. They can then now be more competitive by their own domestic manufacturing or from other countries itself. Right? And the issue is that China, one of the better ones compared to what US is doing, China is supporting much from the government with subsidy and incentive. So that's why you see China market is doing a bit better in terms of with the government support compared to what US is doing for certain sectors itself. But of course, the risk looking at very simple, straightforward, is that the export-oriented market will still be on a downtrend in the US, right, for electronics. And then some of the other different sectors that rely heavily on supply chain. Previously, they are part of the supply chain in China that is going to export to US itself. These supply chain parts or the companies involved, they are going to be heavily impacted. Okay, so supply chain impact will definitely be negative to China still, but generally China will be able to redeploy these supply chains to other supply chain networks for other countries or for through a different production channel itself. Okay. So for tech itself, also one of the more focused one, right? One that you might be more interested in, right? The trade war itself accelerates the domestic investments, all right? So first, they have a lot more push for AI, push for their own products, push for even hardware, software itself. And you do see China actually doing quite well in this aspect, all right? So we do also expect more domestic demand from companies demanding their own domestic tech services and exports from the China market instead of from US that they previously rely on because of the potential fear of impact to them if there's any tariff, right? Because even for this type of imports of services or some hardware for the particular, like maybe servers or some other technological products, they might be very negatively impacted by the tariff. So in this case, then the Chinese companies themselves, they want to minimize the impact, they might buy more domestically itself or buy more from the other countries that offer similar product range. Right? Of course, that also means that they will have limited access to certain more advanced components that is only available in US, or US control certain level of assets, especially for semiconductor, for the high-end chips, for the high-end machineries. US might also impose pressure on their allies to also restrict access to China, which they have been doing, right? So that is one of the key risks to the sector. But so far, we do see that China has been able to sidestep most of these issues, or they are still at least able to continue their developments quite strong nature in terms of the timeline that they are doing. Okay. Agriculture, just now I did show. If you see just now, the three main tariff segments from China on US is on agriculture related, either the products themselves, either the machinery themselves, or even the coal and LNG. So itself, the China government is promoting their own self-sufficiency and also increasing their own local agricultural businesses. So in that sense, this part that is reduced in reliance in US very likely will not go back to US even if the trade tension subsides, right? Because they want to be self-sufficient, they will not be going back to relying on US. Because that means that whatever they have built up again in their own economy have to reduce in demand. So if they're going to increase demand in their own internal domestic production, right, then it will continue on. So in that sense, if you are flip side invested into these segments in US, which is heavily exporting to China, you might see more negative impact to your company's performance in that sense. Right? So of course, then there'll be a short-term increase in costs of the imports, right? But it's more costly from in domestic compared to US. If not, why import from US? If it's cheaper in China, they will have bought from China from the start. It's buying from US because it's cheaper to import in from US. And because of that, if you reduce the reliance there, you're increasing cost to your own internal economy for short term, at least. But in a sense, China is having a semi-deflationary pressure, so they can actually cope with certain level of inflation on that aspect. Okay. So real estate, another one that is heavily still impacted. I personally is not very positive on this segment even until now, right? Even with the government investment and trying to push all these projects, we do believe that the real estate sector itself and construction will still face a lot of issues. The main potential positive that we see in this sector is on the construction itself, not on the real estate. Construction sector will improve because of the number of government projects that is helping to increase infrastructure renewal or developments itself for roads, for public buildings, public services. So you do see an increase in construction potential demand in China itself, and the corresponding counters involved in that sector. Okay. Services itself, I think quite straightforward. You see tourism increase, as I mentioned, right? Education and healthcare also are going to be benefiting mainly on the push of domestic consumption, which is the push of what government is doing. So when the government give out money, they don't give out directly in terms of handouts compared to what US have done. China give out directly through main form of give out is actually through subsidies and also government support through companies to the supporting the reduction of prices for certain services and products. So in that sense, you will still spur consumption, and all of these sectors will definitely be the subset sectors that will be benefiting from this increase in domestic consumption numbers. All right, but the services industry that is related to trade itself, then they might face lower demand because there's lower intra-Sino-US trade demand. Of course, there might be increase, let's say, from China to ASEAN, China to the other part of the Asia-Pacific region in terms of the trade sector. But those that are related to China and US trade services itself, there might be a certain level of reduction in numbers that they are seeing in terms of the inquiries as well as the services provided. So if you focus on Hong Kong, just now I mentioned Hong Kong tourism number has been recovering quite well. However, for Hong Kong itself, they still need to also recover on the financial hub status to really be recovering in terms of the traditional Hong Kong economy, right? And the main issue is that the Chinese firm diversification might move funds instead of into China to US, but move it from China to Hong Kong to actually house their internal funds and stuff like that due to the higher risk of potential clamp down on what Chinese companies can do in US potentially. So there might be more fund flow back into the Hong Kong market. And that especially so if China is actually, if you're not aware, they're actually net selling a lot of US treasuries. So in terms of the overall scheme of things, not only the firms in themselves, the government is reducing reliance on US dollar. So in that sense, they're increasing purchase on gold, on the more international currencies. And in that sense, they might be moving a lot of funds back to the ASEAN or Asia Pacific region itself in terms of the currency, in terms of the fund flow itself. Okay, so that's the thing, right? This is also the tech side, similar to the technology of China itself. Okay, so the macro risk factor itself that we still summarize to, that we are seeing, is the structural risk on supply chains shifting as well as the China property sector. This is the two, right? There is a main issue. Supply chain shifting will definitely continue on, and we're not sure how the impact will last. The next update you will see definitely will be the July on how the tariff will work, and the more definition of how the tariff will they apply on the different countries involved. All right. So there's also a sector preference that may be shifting depending on the tariff impact. So there may be more interest in the lower tariff areas or on the tourism sector or on services sector, for example. So there is a different sector in preference for you. But the one that will stay there almost all the time is the technology sector, right? Because that's one of the key main sector that is required for the economy to actually improve in this current era itself. Right, so next one we're looking at is actually mainly July itself, early July, right? That's the date, early July, first week of July. What is going to be the developments itself? So the recent one that we are looking at now is the impact of US government, their own spending bill, right? How they're going to develop their own issues internally. But by doing so, there might be certain leeways that they might be compromising, right, between the two parties. And that might actually have a certain level of impact directly to how they do the trade talks later on with China and also with other countries as well. Okay, especially when the US Treasury has been selling off so far recently. Okay, so this is the counters, right? Even though there's 4 here, I'll only be touching on 3 due to the time issue today. So Tencent, Alibaba, and Xiaomi I'll be touching on today. All right. So this is the summary of the 3 counters as well as by 2 lah, right? In terms of the business structure and how they're impacted by the trade tension, and also opportunity outlook. Okay, so to just also recap on what they are currently doing. Tencent and Alibaba already announced results on 14 May and 15 of May. Upcoming itself for Xiaomi, here is showing 13 March because the next update is on 27 May. So there is, if you have missed the boat on Tencent and Alibaba, Tencent went up, Alibaba went down. If you missed the boat, you can see on Xiaomi, upcoming 27 May. If you are already exposed to it, you want to do hedging, you might want to participate in the market, up to you, but you at least know the dates involved. The next 2 days involved for these two is on August itself, which is after the July period already. So you might be looking at the July trade issue first before looking at their specific results. But the good thing to note is that for these two, they both actually exceeded expectations in terms of their own projected. But of course, Alibaba didn't perform as well compared to the higher end of the analyst expectations. And that's why Alibaba shares dropped, right? So they outperformed their past, but they didn't outperform what people expect you to do at the current level of valuation that it was trading at. And that's why it dropped. Yeah. Right. So look at the Tencent first, very fast. Tencent, the key things to look at first is they're going to gain from the push on the digital spending. All right. International gaming revenue is still a very strong part of Tencent and it's going to continue. And based on the relative impact of tariff, gaming is not going to be the main source of impact unless US very specifically restrict that aspect itself. But it's very hard for them to do that. So in general, you should see Tencent revenue in terms of stability or the highest of the three. They also want a more diversified portfolio in terms of the impact to the tariff itself. And they have what? Social media, online gaming, fintech itself, and cloud services. Cloud services and the AI digital marketing investments is also part of the AI push itself to increase the AI. And they are doing very well as well on the AI push on Tencent aspects in terms of their own AI modeling, their own AI service integration to their other services that they have. All right. So in terms of diversification, out of the three counters, I would say they are one of the so-called best for now. Okay. So pass time to Jimmy for a while just to share some aspects first.
Okay, everyone, I know you're excited to hear about the levels that Huan Zi will talk about because I'm also very excited. He previously shared about some Hong Kong shares, maybe I think just last month, Huan Zi, and they've all been realized. So hopefully he's again spot on this time. But I'd just like to quickly tell you about an instrument called Warrant, which you can use to trade his views. How so and why? For a very simple reason. I'll show you an example of how and why you should consider warrants. This is an example of how over the past week, warrants have performed. It's a little bit small. Can we zoom in? So I'll give you an example. BYD, phenomenal, keeps breaking record highs this month, right? So it's been up 12% just this week alone. Okay, and the warrant has gone up 46%. Okay, this is a BYD cohort. All right, this is about more than 4 times more than underlying. Let's look at Xiaomi. It's up 8% again in the really special week on the 22nd of May, which was today, right? It unveiled a lot of new products. Of course, it's also declared that they're going to invent their own, smartphone chip. And then they've also come out and aspiring to come out with a DeepSeek kind of a model, which is similar to what Alibaba is doing, right? So very exciting, days ahead. Of course, we're looking at results, as Huan Zi said, 27 May. So we could see more movements, and you see that the stock already up 8% this week. And this warrant has gone up by 5 times more, about 40%. Okay, so this is a 1 week period. This is an example of how some of these warrants have moved. But even if you look across like a 4-week period where, Chinese names have really dominated, some of the stocks that have moved a lot. NASDAQ aside, indices aside, apart from the US indices, which have also moved very strongly, we've seen like stocks such as BYD, Lenovo, Hong Kong Exchange, China Life, Geely really dominating, the top movers table. And of course, by any record, a 13% or even a 9% return on any portfolio for the year, I think is fantastic, right? But in this case, if you had used warrants instead, you could have made leverage returns, in this case, anything between about 4 times to more than 10 times the underlying move. So in this case, you can look at NASDAQ. It's moved 13% over the last month, but this warrant has moved about 10 times more, okay? So warrants offer what we call gearing, where it magnifies the returns. So of course, it goes both ways. If you are wrong, then of course your losses will be magnified. But if you were right, and you were really positive about a good level, and I quote you an example of the 7 April lows, how many of us thought that DBS dropping 18% has never been seen before, right? And surely there's a chance of a good rebound, even if the tariff story was really scary. Well, instead of putting hundreds of thousands into DBS stock, which you're not confident of holding in a long time, you could have paid a couple of $1,000s to get in and really made crazy returns on the warrant, okay, via warrant. So this is the proposition that warrants offer. First of all, ability to magnify if you're correct. Two, they cost very little. Can you see the absolute price of the warrants are anything between 1.6 cents to maybe 30 cents? So therefore it requires very little of your capital. Now I think we're in a stage where all of us have been a little bit frightened by what happened in April. Some of us lost a lot of money. Some of us had a lot of capital wiped out, right? Faced with margin calls or whatever. And now you're a little bit cautious. You're worried about dipping your toes into the water. Now you can do so then at really just a small fraction of your capital. Now you don't like a share. So BYD, it's maybe quite nice for you, and you think, yeah, it's such a pleasing story. But ladies and gentlemen, it costs like $400, right? Which converted to Sing dollars is still a lot of money. We're talking about maybe about close to $100 Sing, right? So instead of paying that kind of money to invest directly, why not? You consider using a small capital, so maybe about 2 cents, which is very little, right? 2 cents Singapore dollars, and potentially gaining a geared exposure into some of these shares. Okay, so this is a quick introduction on warrants and why I was hoping that this is an instrument that you can learn ahead of the 90-day expiry on the tariff talks, right? If April was a frightening lesson for some of you, hopefully, then July, now that you have known another instrument to potentially trade the short-term violent moves, then hopefully it can be a month that is very profitable for you if you use the right warrant to trade. Okay, so how do you select a warrant? I guess that's the main question. There are two types of warrant. Call warrant tracks the underlying to move higher when it moves higher. So basically, if you're bullish in the short term, you will consider a call. If you're bearish, which a lot of Singaporean investors don't know much about, or how to even take advantage of a pullback. How many of us here know how to do that? Because based on SGX's records, Singaporean investors just do not know enough of the various ways and options, literally, to benefit when the market pulls back. Okay, but in very sophisticated markets in the US, in the Hong Kong, you can bet that they are very happy when markets tumble because there's a equal pool of them who's making a lot of money when the markets pull back very sharply. Okay, and put warrants are example of an instrument that allows you to either hedge the downside moves in the short term because of violent moves, because of just how volatile Donald Trump and the news are impacting markets, and even if you don't own a share position, put warrants allow you to profit immediately once markets tank, okay? So if you think BYD record high a little bit too much, Xiaomi has gone up a bit too much, potentially you could consider using a put warrant to profit on a pullback. Now then, how do we select the warrant? I guess that's the question. And in order to answer that question, we need experts like Huan Zi to provide the answer. Why? Because to trade a warrant, you effectively just need to know your entry and exit and cut loss levels. The same steps as you would have when you are selecting a stock, right? Everybody should always have an entry, exit, cut loss level. But what is the difference between a warrant and a stock? What's the difference between buying a stock and buying a warrant? Now, first of all, when you buy a stock, you're probably prepared to hold it forever, right? Which is what some of us are guilty of doing. Really shouldn't, right? We should be getting in and out, based on target levels. But what we tend to do is when we're wrong, we cold storage. We think it's okay, I'll just keep hold. 1 month period became a 1 year period, and like for all you know, it's been 10 years, right? And you're still not profitable. But with warrants, you can't do that. They're really for short-term trades. So, ladies and gentlemen, if you're used to just buying and holding, I think now is the time to also consider a change, because I think a lot of even experts or research analysts, they are now a bit afraid of even putting out a 12-month target, because fundamentals, as a lot of people say in this Trump era, can go out the window any day, as long as his comments, move markets in a violent way, right? I mean, however fundamentally strong a stock is, it's still going to come crashing down 18% like DBS. Okay? So you can't hold on to it forever, and they're really giving you the leverage in the short term only. So the holding period is really only for the short term. How short term should this be? We've got tools to tell you later, but that also in turn depends on your entry, exit, cut loss views. Okay? And so I think with that, I would like to pass the mic back to Huan Zi to provide us some of these views on, I think, some of the shares he's talked about: Tencent, Alibaba, Xiaomi, and of course the Hong Kong broad indices of Hang Seng Index and Hang Seng Tech Index. And then thereafter, I'll take over the mic and just show you very quickly the kind of expected returns you can have if you traded a warrant with his view instead. Okay? So I'll just pass this back to Huan Zi.
Right, thanks Jamie for sharing. So basically, now we move back specifically to how Tencent is moving. So if you are a person that invested in Tencent, right? So if you are not invested, you're looking more on the upside or downside directly, more on the short-term trading. But even if you are already invested as a stock and a shareholder, right? You're already holding on to the shares. You might want to hedge your risk on any potential downside. So you can see that my upside, actually my resistance level, right, is actually at 2.5 and 4.8%. And compared to the support level, they are actually further away at 3.4 and 7.6% away. Meaning that any potential pullback might actually be slightly more than the upside swing up before they hit the resistance level. And based on the current trend right now, right, I think if you see the recent performance today, there is more swing towards a pullback that we are seeing for this week and also potentially until next week itself, based on the current movement of the treasury yields in US and also the risk tolerance reduction by a lot of investors worldwide. All right. So you see currently this is the level here, right? This sudden drop in April in the right side. This is the point where the April happened. All right. Of course, now you have pullback, recovered almost back to before what the tariff announcement impact was. But if you're seeing that this impact was due to that crazy tariff suggestion by Trump, 100+% on China, potentially July, even if they hit a deal and he go to back to 50 or 70%, you do actually see a potential correction down to the support levels as well. So it potentially can have big swings upcoming. And just to recap, basically again, the downside is slightly more on Tencent than upside based on my own personal opinion, right? But of course, like I mentioned, they are very diversified. So for super long term, if you really believe in China story, I think Tencent is one of the one that you wouldn't mind holding for longer term. But in terms of short term swings and you want to hedge yourself, can consider some other aspects or some other instruments to hedge your position. For Alibaba itself, they are benefiting from consumer demand, all right? Of course, business sentiment is down, but consumer sentiment is up, right? But the latest news that I have personally is that previously, I think you all know Alibaba compete with a lot of companies, like, right, maybe there's Meituan, there is also companies from the, let's say the Xiaohongshu or that they also do the thing. That's the one that you mentioned. Recently, JD came into the fray on a larger scale, so giving a lot of subsidy. And from what I understand is that they are giving a very large coupons to actually encroach into the market. So in terms of this aspect, of course, is a very high competitive nature. But the good thing for Alibaba is that they are actually very diversified in the sense that they have Taobao, Tmall, AliExpress. And in terms of these three, AliExpress as a service and Tmall as a more advanced or more high-end targeting type of e-commerce platform, they are not as hit as much with all these competitors that are hitting more of the more budget economic scale e-commerce products. Right, so technically the JD one coming in, except for the JD high-end, which they already have been doing, they will affect Tmall. But the new platform that JD is doing for the delivery and stuff, they are hitting more on the lower end targets, which is more on Meituan than on the Alibaba impact. But the global operations, right, still impact them. So there is a supply chain issue where they are seeing less shipments to US, right, due to this tariff impact. They might be needing to diversify to other countries in terms of their cross-border e-commerce platform. All right. But the bright spot for them also same thing as Tencent is that they do also have a very strong cloud computing exposure in terms of their cloud storage, their cloud services providing, and also the AI aspect that they have in terms of integration of services that Alibaba is doing. And so the global partnership, even though it might face disruptions with US, but potentially I do see quite a bit of bright side for Alibaba in this aspect. And you can see that in the share price as well. Because in general, even before this whole tariff happened, when the start of the year happened, when there was a shift of funds back into China due to the DeepSeek and other AI related investments, Alibaba actually rose a lot more than Tencent in terms of that particular rally itself. Of course, the drop back down in terms of the impact also was there, but then now it's back up to around 1.2 plus level, near 1.22 low end as of I think 21st of May itself. Okay. So the upside 4.9%, 8.5% is slightly more than the downside of 3.7 and 7.6%. Basically, mainly because the recovery of this Alibaba is not as much as Tencent compared to the peak that they have faced in the month of March. So there is just a lot more room to go back before they hit the resistance level for Alibaba. And based on their direct impact, based on the tariff itself, we do see that a lot of times the tariff risk has been priced into Alibaba more than what is priced into Tencent, right? Because of the correlation that it has. So in the sense that even if the tariff impact goes a bit more negative, the downside is more limited than what Tencent might face. And thus, in terms of the risk reward ratio wise, I think Alibaba might have a larger upside potential than downside in risk to reward ratio for yourself. Okay, for Xiaomi, I mentioned by I think Jamie just now, they do have a lot more offerings, and they at the start they always do affordable smartphones, all right, and they benefit from the trade-in programs which China want to do to recycle their phones and also to upgrade the technological phones that they have in the country. But they also encroach and go into new products like cars, high-end phones now also. Their high-end models now can actually directly compete with the high-end models across the large smartphone makers. In the past, the highest end smartphone that Xiaomi is doing is around tier 2 of the others like Samsung and also the iPhone. But right now, they are actually aiming for the highest tier, the top tier end of the smartphone, which is the highest profit margin as well. And even though we are not sure how their performance will be in that segment, I mean, but at least when Xiaomi move in there, they do have the potential to do well, especially when the their EVs has already been giving them a better reputation across, I think even the European area itself in terms of their brand name, right? But Xiaomi itself, based on the fact that they are also a lot more hardware driven, a bit can draw a correlation to how Apple is doing, right? They are also reliant on global markets and supply chain networks, which they are going to be a lot more vulnerable to tariff impacts, right? So like I mentioned, similar to what Alibaba is, they are priced in a lot more for tariff impact on their current share price compared to this Tencent itself. Okay, and in terms of trade restrictions, they are going to have a more limited expansion plan, which they previously wanted to expand into the Western world. All right, so now they have a lot more this reduced ability to do that. And when their parts increase in cost for being a name or known for affordable phones, when their parts increase, the cost of manufacturing increase, their price competitiveness will reduce compared to the Indian counterparts, which is their main competition in the low-cost smartphone makers itself. All right. So of course, their push into EV have been proving to do them very well to actually improve their brand image, and that's what I feel will then give them the whole network effect for their company itself. Right. So if you compare this movement, right, if you see compared to the last two charts, you see that actually their move up started way before the other two tech stocks from here. All right. So it was actually since I say 2024 mid-year, they have already been having that strong rally, excavated in the 2025 start of year, first quarter. All right, with the push fund flow into China and into Hong Kong. All right. Then of course the impact came down on the tariff. You see that also their pullback here started earlier. Why? Because they were impacted even at the very start, the automobile tariff from US. So even before how the tech stocks was crashing on that day of April itself, Xiaomi already had that downtrend impact, which is why I mean they already been pricing in a lot of the tariff impact. even now, the tariff is still ongoing for automobile and also the flat blanket rates. So this current price performance is already pricing in that level of tariff. So if any deals cut across, technically for Xiaomi, they are at a better position in terms of the pre and post impact tariff of any new deal, all right, compared to the current just a pure pausing. Then they are actually more positioned to do a recovery than the tech stocks, which is not yet known what Trump will do to them, right? Because the automobile tariff has been ongoing and is still imposed on them. And thus, you see the upside is at 4.2%, 6.7%. The downside is further away, 8.4, 12%. Doesn't mean that is I feel that they will go down more, but just that I feel that currently their support levels is quite far down because there is no real significant support in between in the nearer short-term zone. So there might be some short-term swings in terms of volatility that is seen on the Xiaomi stock performance, but I do personally still feel more of an uptrend direction for Xiaomi performance, at least for the next 1 or 2 months itself. All right. Hang Seng Index itself as an overall index, right? So this is the performance resistance 24260 and 24894. Currently, I think it's trading at 23200 plus, if I'm not wrong. 23200 or 23400 plus already, I think, after the recent drop today. All right. So I think it was 23700 plus when I put the chart. I think now it's 23400 plus, if I'm not wrong. Okay, but do see that the next one they're looking at, the support is 223,000. All right, so maybe around 1.5% to go, right, to the first main support that we do have. Tomorrow we can see, all right, or 2+% away for the next support level itself. Okay, but if you see the trend itself from April, the uptrend swing is very strong, all right, the recovery is very strong. And if you draw a same trend line here, this gradient, they are about the same, the two gradients here and here, right? So in a sense, there could be potentially another correction when this time frame come back to a play. So we're looking at a potential correction, even if there's no correction now. Correction level is very strong likelihood between 24,200 plus to 24,800. There might be a strong correction in this zone. So if it goes up now, it might come back down in a strong way until the 22,000 levels, all right? But of course, right now we are seeing it already happening before even touch 24,000 currently. Okay, I mean for today and this week. Okay, the Hang Seng Tech Index, more specifically focusing on the tech counters or tech counters that are related to tech companies. All right, you will see the upside of 3.3%, 5.4%, or downside of 2.4 and 7%. All right, for tech, Hang Seng Tech, I think in terms of the trading of the warrants, is a lot more volatile and a lot more volume trading into the Hang Seng Tech Index currently this year and last year, end of year, compared to the past. I think there's a lot more demand because you might not know specifically which counter. Like let's say you are not sure buying into Alibaba or Tencent or Baidu or into Xiaomi. You'll be looking at the proxy, which the proxy, a more stable proxy will be the Hang Seng Tech Index, in the sense that they are diversified between all the way from software, services, and hardware. So they do have a more spectrum diversified into one particular metrics. And also usually the index level ways of warrants and instruments, they do have a larger leverage ratio also. Right? So it means that you might need to only put in less capital for the same exposure to hedge your position as a proxy. Okay, so right now you see that there are a lot more sideways movement compared to the pure upside just now. If you see compared to the Xiaomi and also to the Hang Seng, which is uptrend all the way. For the tech, you can see that after the peak, they actually not even at the peak right now, and they are coming down. So it's more of consolidation. And this consolidation gives more faith that there might be a uptrend potential swing if everything goes smooth or not as bad as expected for tariff developments compared to the other sectors, which is actually more vulnerable. But it means that there was already too much optimism in the other companies potentially. There might be some potential pullback in certain of this outperformance back to take profit or to lower exposure itself. But for this one, I think the index itself, the tech index have been more moderated in the upside movement. So it should have a better control in the recovery after that. Okay, so I'll pass the time now to Jamie first to share on her aspects.
Thank you, Huan Zi. So I promise that once Huan Zi gives his views, I can then demonstrate to you exactly how the warrants will perform based on his view. But before I go on, just a curious question. How many of us here are shareholders of Alibaba? Quite a lot. And indeed, like Huan Zi said, it's probably one of the most popular Hong Kong stocks among Singaporeans. Because a lot of people would have used Taobao at some point, right? Whereas versus Tencent, anybody holding on to Tencent? Okay, fewer hands. Are you all gamers? Because unless you use WeChat, actually a lot of Singaporeans don't know what Tencent does, right? Unless you game, then you're aware. Oh, okay, the games are from there. Xiaomi. Anybody a shareholder of Xiaomi? Okay, even lesser. I nearly became one, and I really should have. Huan Zi was talking about how Xiaomi was aspiring to come out with top tier phones. My dad told me 4 years ago in 2021 that he wanted to buy the top end Xiaomi smartphone at $1,800 because based on the market review, it had the best camera, will beat out iPhone and Samsung any day. My dad's 81, and I thought, okay, you know what, at his age, okay, if he really wants for his birthday, I'll get it for him. And back then, I joked to my friend, I should buy Xiaomi shares because I was paying so much for this phone, right? That was when Xiaomi was $20. And of course, deep regret. But hey, for you, if you haven't gotten into the Xiaomi story and you think this is not a bad one, um, potentially you can then use a warrant in the short term. Why? Because obviously Xiaomi has gone up close to 3 times from 3 years ago. And Xiaomi continues to be one of the most popular Hong Kong stock on financial websites. So actually, if you go to, whether it's other brokers or financial websites, some of the top search stocks include Xiaomi. Okay, so time to know about it and to hopefully participate in it and make some money to buy a new Xiaomi phone, or better still, the EV. With those returns. But I just want to start off maybe with the broad indices of Hang Seng and Hang Seng Tech before we go into the shares, because it's most recent. If you noted down the views that Huan Zi talked about, I mean, maybe we'll start off with Hang Seng. So just to quickly introduce you this tool is called the Warrant Selector tool. Because why? It's used to select a warrant. It can be found on Singapore's #1 warrant portal, warrants.com.sg. And you navigate from the warrant tools drop down. This is the second drop down, okay? Very easy, like I said, to select a warrant, all you have to have is what? A view on what? Anybody? A view on the what price? Entry and exit cut loss, which Huan Zi has given to you, entry and exit. So first of all, we start off with maybe the Hang Seng, okay, Hang Seng Broad Index, which by the way is one of the most popular indices traded during Singapore hours, okay, because it's so volatile and it's really quite seen as the market leader in Asia, and so Singapore traders are constantly looking at it as well. So let's say if you were bullish, of course there is the option of being bearish, but we're not too far away from the support level that Huan Zi talked about, around 23,040, right, Huan Zi? So if we're not too far away, maybe we think, okay, maybe at that point it's good to go long. But of course, again, when April came, the first instinct, markets are going to plunge. For some people was, okay, let's see how I can hedge. Of course, market opened down 12%. And then it was down 18% during the day as well. Then at the point, you click on a call because you think it could bounce in the short term. Okay, but bounce in the short term, unless we are fundamentally bullish until, I don't know, like we think Xiaomi is going to go $100 and you're willing to hold on to it until then. Being short-term bullish means you need to have exit levels. And once the profit-taking levels are there, you exit. Why? Because I think at this point, when fundamentals are off the window, what's everyone using? Technicals, right? The whole world is looking at it. That's where traders are going to get in and out of, right? So that could provide either a buying support or a selling resistance, at those levels. Okay, so I was saying we were bullish, so we click on call. And then there's a chart of the Hang Seng. But if you scroll down, it tells you the last price was 23,500, right? On the index futures. Now, we only want to get in when it's around 23,000 because at this point, not a lot upside, right? The upside 24,200. And we think we want to get in only around 23,000, maybe 50, right? In this case, you can type it here, 50, 23050. And what it's going to do is instantly, it's going to update the current price of all the warrants tracking Hang Seng available. Okay, and that's where you could look to buy the call warrants. Okay, so Hang Seng traded at 23,000, but you can get in at anything between 2.5 cents to about 20 odd cents. Okay, we need to know where we want to get out, what kind of expected returns we can have if we got out at our profit taking level. Do you all, anybody remembers what the first resistance Huan Zi was, first resistance level mentioned by Huan Zi and Hang Seng? Anybody? Resistance. We're buying at around 23,050 on the upside. Even if you cannot remember exactly what level he said, typically when indices it's very easy to remember. At every 1,000 is always a resistance level. That's what people say. Especially if it's like a big 23,000, 24,000. Okay, so it's around 24,200, right, Huan Zi? You're talking about, in that case, if you wanted to get out 24,200, for example, which is 5% higher from here, what this tool tells you is when you click up here on the number of weeks, it's going to simulate the returns of the warrants for you. So what this means is that if Hang Seng moved up 5% in a week's time, not difficult. Sometimes you can move 5% in just 2 days, okay? Which is why Hang Seng is so popular, because it's so volatile. It provides a massive range for traders to trade, right? To get in and out of within a short period of time. This market going up 5% in a week's time. These warrants here will move between 42% to 81%. Now, that is between 8 times to about 13, no more, 15 times, 15 times more than the index. And this is what warrants provide you, the ability to magnify, okay? Between anything from 2 times to 30 times. In this case, with this list of warrants, you can see anything between 8 times to about 15 times. But what you will note if you are processing this table is that the longer you hold on to it, the returns get smaller, right? So if this happens in 4 weeks' time, you see the first warrant here, only up 1%. And then these warrants here, what happened? Is in the red. Your view is right, but it's in the red. Okay, this is what we call the process of time decay, where the value of the warrant decreases with time. This is called the holding cost of warrants. Okay, which holding costs exist across leverage products, whether it's the CFDs or other listed leverage products like DLCs, etc. Okay, but how CFDs compute this is they charge you separately, right? The finance cost. But with warrants, the holding cost is embedded in the value of it. Okay, so what we really want to know is what the maximum time horizon we've got when we trade such instruments, because that's key to you making money. Basically, I think a lot of investors have the very lousy habit, including myself. 1 week time, oh, well, we made 60%. Then we wait for a while more. Maybe we'll go above 24,200 to the next resistance levels that Huan Zi talked about, right? And then we don't get out. And then before we know it, like by the 5th or 6th week, then this becomes 1%. Okay, so what this tool tells you is if your view was that it will be in a month's time, right? We want to get out before the 90-day tariff basically, update, right? And we want to get out before July comes. And in that case, if you give yourself a maximum from now to July is about 6 weeks, okay? You give yourself a maximum of 6 weeks because you think by then it might not be bullish anymore. In this case, you really want to just probably get into this warrant here. Why? Because it's still profitable by the 6th week. Of course, if the market hit it before 6 weeks, by the 5th week mark, then you have a lot of other warrants to consider. Okay, but by the 6th week, you probably would want to only look at that warrant 9V9W. If it's a 5-week holding period, easy 5% move, which the market can hit in 5 weeks, then you basically have the choices of this 7.7% to this warrant that makes 48%. Why would you not consider the first warrant anymore? Because if you traded the warrant, you no longer get the amplified effect. You no longer get leverage because time decay has eaten into leverage, okay? In this case, if you bought the futures directly, you make more, right? In terms of gains. So this is how you use the tool to narrow down the number of warrants that you can select, you want to select. And finally, to know based on the warrants you're looking at, what your maximum holding period is. So the question you might have is, what if by the 5th week, the market doesn't hit 24,200, or rather I should say by the 6th week? What if by the 6th week, the market doesn't hit 24,200? What do you think you'll do? if you had bought this warrant. By the 6-week, market still hasn't hit 24,200, your target level. Sell, you cut loss. Why? Because even if your view was right, it's only making you 8.4%, not much leverage, and you've held on for another week. Even if your view was right, you are making only 1%. Right? So you really should cut loss. Of course, maybe you want to hold on to the 7-week, but by 8-week for sure you'll be in the red. Okay, this is an example of really how if you don't know your holding period with this kind of short dated trading instruments, you're always going to lose money. This doesn't apply for just warrants. With any short-term leverage product, you're always going to lose money if you don't know what your maximum holding period is, which is why we invented tools like that to give you the answer. Okay, now let's move on to the next example of Hang Seng Tech. Hang Seng Tech, yeah, there you go. Hang Seng Tech is a really interesting one. It moves more than Hang Seng because this current rally post-tariff has been led by Hong Kong tech names, right? By the likes of Xiaomi, BYD. Of course, earnings season as well. So, you know, basically earnings for some of these companies have really exceeded expectations and lending the index a big boost. Now, there are lesser Hang Seng Tech warrants compared to Hang Seng warrants, but still 4. So how do you narrow down your search? Again, the question is, where do you want to get in? Do you want to get in now where, you know, your returns are kind of like, your returns versus losses are similar, right? Huan Zi, what was the resistance you talked about? Yeah, like 5490, and then you know the support he talked about was around 5,250. Anybody remembers this? Hang Seng Tech support first level. I think it was around 5,002, you know. So if that was the case, sorry, I think it was a bit lower, right? Because the market is now at, yeah, there you go, 5,000, around 5,200, like call it. So actually now is probably not a bad time to look at whether the Hang Seng Tech will get supported. In other words, we're very close to the entry level, correct? Because the last price of Hang Seng was what, 5? If you click on reset, it was 55258. So maybe you want to enter around 5,200, or if you want to be very specific, 5188. Again, the same exercise, you just need to put in the last price to see what the current price would be. And what do you do next? Put in where you're expecting it to trade onto, which I think is around 5,400 or 5,450. We can enter maybe 5,400, Huan Zi. Okay, again, not much upside, but still about 4%. And how can we leverage this 4%? Doesn't sound like a lot, but in 2 weeks, basically, the warrants are then going to magnify that 4% for you, or less than 4%, to give you gains of between 20% to 30%. Right? So if the gains are not enough for you, because you think, I trade in and out only 4%, you know, and trading fees, brokerage fees, and all that, how much will it be really? Well, then you can look to amplify the returns via any of these 4 warrants. I have to mention all the warrants that we show here on this tool are warrants quoted on tight spreads only. So those that are wide spreads, we eliminate it for you. So, you know, to make it easy for you to select, right? Because you should never trade any instrument on wide spreads. Never, because that's not cost efficient. Okay, so same exercise by the 3rd week. This last warrant here is going to lose you money, even though your view is right. And why is it? Well, we have a clue, because it's going to expire soon. It's going to expire next month, right? And that's why amongst the warrants, you can see that it's the cheapest. So just so you know, warrants around less than 5 cents tend to be the most popular. Why? Because least amount of capital required. But amongst the different warrants with the cheapest, you can be very sure it's the riskiest, always, right? So it shows up here. Indeed, if your view is not right in 4 weeks, you're going to lose close to 100% of what you placed. So be very careful with trading overly cheap warrants, because they usually come with what we call higher effective gearing, which is higher risk. But if you're right, of course, it's going to grow your money even more, okay? In fact, the most in terms of percentage gains. Okay, and that is Hang Seng Tech for you. So again, if 3.8% not good enough for you, well, within the 2-week period, you will be, 1 to 2 week period, you will be making leverage return, geared magnified returns with at least 3 of the warrants here, which you can choose from, okay? You'll notice we have a little fire logo next to some of the warrants, that is to indicate the hot warrant, which is on the highest, which has the tightest spreads and highest traded volume, highest volume provided by Macquarie on the bid and offer. Okay, that's how we also know Singaporeans like shortcuts. So what's the quickest way? We put a fire logo there for you. Okay, but of course, use this tool to know your holding period and select according to what you like. That is the warrant selector where you can select and narrow down to one warrant. But with any of the warrants, when you click into it and you're a bit interested, okay, then how do you transact? How do you find out more? You can actually click into the hyperlink. We always encourage people who want to trade warrants to open this website alongside your Poems platform. Why? This website tells you everything you need to know about the warrant, but the Poems platform is where you go in and execute, where you buy. So, on some of our pages, actually, once you scroll further up, we have got a trade warrants here, but you don't trade on Macquarie's website. It will show you a drop down to various brokers, including Phillip, okay, including your Poland's website. Okay, and then you go in and trade away. But whenever you click into any of the warrant, it's going to take you into this page called the live matrix. What is the live matrix? Essentially, it tells you live during the day, at any point in time when you're looking at it, how this warrant is moving alongside the underlying live. So if you don't know where the warrant is going to be, you want to get out at 5288, for example, you go in at 5,200, then you think, hey, the news doesn't look so right. So you want to get out already, you're a bit scared, right? Then what can you do? You can look during the day at the line matrix, look at where the level you want to get out at. Don't need to look at the warrant price. Look at the level you want to exit, because you always base your entry and exit based on underlying exit. So you just need to look across, search for 5288. Okay, that's where you want to get out in the index. And then you look at the warrant bid price, 5.3 cents. So that's where you can type into Poems, your Poems platform for this warrant, and exit at 5.3. So you can put a limit sell order there, and that's after maybe you got in around, 4.8 cents. And you're happy to take a profit, right? And enjoy the weekend. Then this is the live matrix. It is piped out live from our market making system. So it's fully accurate, and it tells you, it updates you according to where the market is. The blue bars refer to where the index or stock is currently trading live, okay? Of course, the market is shut, so that's where it closed at 5 cents. That's what it's telling you. So from this page, it also links up, Huan Zi, can we move upwards? It also links up to more. It also links up to the other tools that you can use in order to know how the warrant has traded. So for example, if you go to historical performance, okay, the from button, when was it listed? Oh, it was only listed very recently. But for all the other Hang Seng warrants that existed before, if you go to historical, you will be able to see how much it's moved versus the index. Okay, so that's what you can do. And then there is a tool called Exposure Simulator, which I want to tell you about. Remember, I told you one of the attractions of warrants, that you don't have to come up with your hundreds of thousands of dollars to take a view in whether you're Tencent or Alibaba or Xiaomi. You can do it at a fraction of the share price. But how much? How much should you be coughing out? So we came out with this tool called the Exposure Simulator to tell you exactly that. To use this, you need to know which warrant you're interested in. So let's start with Alibaba, because we've got the most number of Alibaba shareholders here. So we select underline Alibaba. If you're already a shareholder and you think, okay, results weren't that great. Could it face further downward pressure because of intensifying competition, with Meituan and JD and all that, or just simply, the tariff news continues to provide nerves, right, to the market. How do you hedge the downside? Huan Zi provided support of $112.50, right? So if we were bullish in the long term, but we're worried about the short-term pullback, what can we do? We can use a put warrant to hedge. Now, just quickly, in the interest of time, the main put warrant to look at is this warrant, FYSW, okay? And we click into it. Of course, you can choose it from the warrant selector. Okay, and what you do here is you put in the number of shares you currently own over BABA. So in this case, let's say you are holding $25,000, 25,000 units of Alibaba. Okay, we shift a bit. Okay, that is about, shift a bit more, higher. That's about 111,000 Singapore dollars. Yes, okay. Sorry if it's a bit small for those behind. Okay, so basically, if you own 25,000 units of Alibaba shares, in Hong Kong dollars, it's around 500,000. In Sing dollars, it's about 111,000. Okay? So for those of us who think, hey, Alibaba sounds good, right? Quite sexy, because Huan Zi said, hey, this stock seems like the best fundamentally of the tech stocks. You can either, of course, buy Alibaba shares directly, traded on the Hong Kong stock exchange. You can look at Baba ADRs in the US if you know you're a night owl, you like to trade US hours. But you can also consider using just a fraction of this amount to potentially, the hedge. How do you hedge? If you are looking at this warrant, it's got an effective gearing of 4.4 times. What does this mean? This means that if Baba moves down by 1%, okay, so you're a shareholder, you want to hedge on the downside, right? Of course, if you want to buy, then you consider a call. But now we're talking about hedging. So if Baba goes down 1%, 4.4 times means that this put warrant should go up by about 4.4%. Okay, 4.4 times more. Now, to invest into this warrant, my bad, sorry, this underlying portfolio view is like $500,000, right? To then invest in this warrant is you use basically about 20% of it, which is 111,000. A lot of money, right? Because I just said with warrants, you don't need to use so much money. So maybe we dial down the fact that we are owning 25,000 shares, Huan Zi? Shall we make it like 10,000 instead? Because is this typically those who are Baba shareholders? This is a big amount, right? To buy into Baba. Or maybe you all own that kind of amount. I mean, okay, if you own that kind of amount, then you have to use 111,000 to buy the put warrant because your shares portfolio size is so big. But I mean, yeah, yeah, I know some Philly investors very big, but in this case, let's say if you bought into like $100,000 worth of Alibaba shares, okay? This is your portfolio. Then to hedge with this put warrant, you need to cough out $22,300 to hedge. How many warrants does that equate into buying in terms of units? We have calculated it for you, 507,500. So 500,000 units with using $22,000. Okay? Where must Baba go such that it will fully hedge with this put warrant your losses on your share portfolio? Okay, so recap, you're looking at put warrant because you own Alibaba shares and you're worried that it could come down to a key support level. At the key support level, when you're short, you get out. Some people think, hey, I own Alibaba shares, then I just keep buying a put warrant and hold forever, right? Because then I profit on the down move. But then your share portfolio is losing. So basically, you should never bet on the downside when you're already a shareholder. You're looking at hedge. And you're looking at hedge because you think in the short term there could be support levels, or maybe you even want to get in there and average down, right? For example. So you should get out when a support level has been met. This is how you short the market. Shorties don't always short until it goes to zero, no. Shorties always short the market until a key support level is formed because they know that that's when buyers will come in, right? To bargain hunt. So they always get out. Okay, so when you short, always know where the support levels are. When you're long, always be aware where the resistance levels are. So in this case, the support level I think was what, 112, about 112. Okay, 112.5, which is a 6% move from where we are now. Maybe it's not a lot, but maybe in the short term, you're still worried about this 6% move. Okay, I'm sure Huan Zi had a further downside, right? But let's just say for now, if you're worried about this 6% drop in the very short term, scroll down, please. Then what this means is that, scroll down. Your share portfolio is going to lose $5,400. Okay, if Alibaba came down 5.5%. With this warrant, it's going to make you $5,500, more than enough to cover and offset your losses. Okay, but within what time period? Right, with warrants, you must always ask yourself, how long or how short a time can you hold it? Well, this is saying that in 8 days' time, in 5 days, it's still going to fully cover. But as you move the number of days in this tool, can you see that the returns are dropping? Why? Because of time decay holding cost. Now, if you hold this for about a full month, the absolute returns you make from the put is not enough to offset your absolute losses in your share portfolio. So there's something to note. So in other words, if your view is only that Alibaba shares are going to be down only 6% from here, your holding period is in fact very short, around 5 days. But if you held for a longer period of time, even though your absolute returns are lower, okay, so for example, if the rest of you are not Alibaba shareholders, but you just want to profit from the downside, okay, because you think, Alibaba doesn't look so good in the short term, then you can keep holding for 30 days and you're still making a magnified return of 13.5%, right, which is about 2.5 times more than Alibaba share drop. Okay, so this is how you can use this tool. Of course, if you're a shareholder, you really just want the absolute returns to offset, so your holding period is shorter, unless your share price was much lower lah. So Huan Zi, if you do like 100, for example, 100 in the share price, maybe that's where, again, coming closer to July, you're really worried about that, because it did go there, didn't it? Alibaba went below $100, isn't it? $85, I remember, and my colleagues were saying, we'll buy at $80. Well, they never got it, of course. It's 16%, then holding 30 days, no issue. You're still going to make that $18,000 to offset your 15,000 absolute loss. So what does this tool tell us? If you're looking to hedge as a shareholder, you're really hedging for this kind of like almost doomsday, which is not impossible these days, right? I mean, 16% is not difficult, from July, right? It happened in a day, happened in an hour, right? So this tool is for you to know and to position ahead of this crazy volatility if it happens again, and we know it will happen again. Okay, and for those who simply just want to buy a put to make money from the downward move, you're going to make 82% versus a 16% drop, and you can continue to hold it for more than 30 days. Once, can we move it down? You can hold it for very long. You can keep moving it. You can hold it not all the way. Okay, we want to keep moving it until we don't see much gearing left. So you can hold this for half a year, and it's still going to make you 43% return versus a 16% drop. Okay, so ladies and gentlemen, if you didn't know about how to profit from a downward market previously, I hope you know about it now. Okay, I think this is especially something you can especially note for stocks that are currently trading at record highs, right? Because we're 1.5 months away from what could move very quickly in the opposite direction. I don't know. Okay, I think nobody knows except Trump at this point. Okay, so this is what we call the exposure simulator, and this was how you can estimate what the returns are using Alibaba put. I'll very quickly talk about a Xiaomi call, and then we'll end it. But how can you also use this tool to show the difference between investing in the Xiaomi share directly versus a Xiaomi call warrant? So Huan Zi, if we go up back to this tool called the exposure simulator tool, we change this drop to Xiaomi. Okay, and then we choose the second warrant here. Always choose the one that it takes longest to expire. So I know this takes longest because if you read the name backwards, is 4th of July 2025. Okay, so currently it costs about 8.1 cents. Now, if you were thinking of longing Xiaomi shares, right, ahead of earnings, you can either buy, I don't know, 25,000. How much is 25,000 Xiaomi shares? Definitely less than Alibaba. Yeah, you can spend 220,000 investing in this Xiaomi shares directly, or you can consider this warrant, which costs 8.8 cents, has a gearing of about 3 times. Okay, sorry, I think Huan Zi just changed it to 10,000 shares. So you can either invest 87,000 directly buying the shares and becoming a shareholder, or you can spend $27,000 with this warrant to replicate your exposure. This one has a gearing of 3 times, which means if Xiaomi shares went up by 1%, this will go up roughly about 3 times, 3%. Okay, how many units of warrants to buy in this Xiaomi? 311,000. We basically told you everything lah. No, we spit it out for you so you don't have to do any calculation. How will this warrant perform? Now, if in this case we're not looking at hedge, we're not looking to replicate, okay? We're looking to replicate, but let's see how it will work. So Xiaomi, where do we want to get in? I think that's the question. Xiaomi, your $50 is probably not a bad entry price. Like Huan Zi said, Now the profit versus loss ratio not ideal, right? Upside only what, 8%, downside 12%. So we probably want to get in when it has a better profit loss ratio, isn't it? So maybe we get in about $50. Okay, sorry, then if that's the case, Huan Zi, we need to change the, yeah, we need to change the underlying price because we only want to get in when it's $50. In that case, the warrant will cost less. It will cost 7.2 cents because the stock is lower, right? So the call will track it lower. In this case, instead of spending $82,000 buying Xiaomi shares, you use 25,700 to buy this Xiaomi warrant, okay? So you enter when it's $50. And of course, you exit when the profit target levels have been met. In this case, I think we're talking about $57 target price, right? And then now, of course, the ratio looks better because we're talking about a 14% upside and a much smaller downside, right, in the sort of support level. So if you bought Xiaomi shares directly, what this means is that Xiaomi shares, if it's gone up 14%, okay, from $50, you make $11,500. This warrant, if you buy it and you hold it for 21 days, it's going to make you 44%. So that's about 3 times, like I said, 3 times and a bit more the underlying, right? That's what we're expecting. In terms of absolute returns, it's going to match Xiaomi shares. So if you want to consider Xiaomi, just know that with this warrant, your maximum holding period is 3 weeks, and then you're going to make 3 times more than Xiaomi shares, okay? If you continue to hold longer, the absolute returns drop, okay? So you can't replicate the stock because if you bought the shares, you still make 11,500. But with the warrant, you only make 9,000, okay? The longer you hold. But you see, again, the leverage return continues to be more than Xiaomi shares. So depending on how you look at it, whether you're looking in terms of percentage or absolute return, if you're looking to replicate the exact same exposure, your holding period is shorter. If you're simply wanting to make leverage return, like I mean, who doesn't want a 30% return on their portfolios? You can hold this for 2 months and it's still going to make you 30%. Okay? So again, holding for longer, lesser absolute returns, but it will continue to provide you magnified exposure to the stock, which you can't get from the stock directly. Okay? So with that, I've come to the end of the demonstration with the exposure simulator to show you how you can either hedge your portfolio or replicate a stock portfolio. I show you the warrant selector tool to show you how you can narrow down your selection of warrants. Okay, I just want you to know the maximum loss for warrant is 100%. But will it get to 100%? The answer is not so easily, unless you ignore this holding period, whatever I've taught you, and you just decide, I lost so much already, I just hold it long until expiry. Then I hope for the stock to rebound. I've just shown you that cannot happen, right? But a lot of investors like to hold the expiry because why? Out of habit. Because with stocks, sometimes we hold for 10 years, we finally can break even. Doesn't happen with warrants. They all have expiry date, okay? And they're short for short-term trading. The only time you make 100% is usually when you hold the expiry. And whilst it's painful to get out at a 70% loss, at least you get the extra 30% from your capital, and then maybe use it to buy another warrant that can make you 70%. You know what I mean? You can still save the small capital, however small, to buy a warrant because they're so cheap, and still try to, hopefully this time it multiplies the returns for you to cover your previous loss of 70%. So please don't hold warrants until expiry. It's, to me, the surest way of losing 100%. But even then, it's only 100% of the small capital compared to margin positions where you have to keep topping up margins and your losses can be unlimited, especially in very volatile markets, okay? So this is the proposition of warrants, high risk, hopefully, calculated, managed returns. Let me know if you want to know more about warrants. Happy to put you on our company WhatsApp where you can easily just text us to ask us more questions about specific warrants, especially if you have bought them. Just let me know if you would like to be placed on the list. We frequently have seminars that we do where we talk about warrants in detail. I recognize some of those people who have attended some of those. So that one, we will do like a 1 hour session where we tell you a bit more about the product. But if you don't want to wait till then, we can also arrange like a Zoom demonstration for you based on your view on the underlyings and tell you what your holding period is, how you go in and trade and all that, okay? What are the fees involved with trading a warrant? It is the same brokerage that you pay to Poems or Phillip as you pay with shares, right? But because warrants cost so little, typically the brokerage is really quite little. The trading and clearing fees are really small. All right. They are an SIP product, so you have to check with your broker whether you are SIP qualified. That one is not something we mandated. It's what MAS have said. So if you have any further questions, you can either ask now for everyone's benefit, or you can come up later and ask me one-on-one. Any questions? I mean, if you don't have questions for me, you can also feel free to ask Huan Zi. Like, where are the cut loss levels? I mean, he'll tell you the support lah, the support break already, then you cut loss, right? Resistance and break, then you cut loss, right? You know, if you were short. Yes, sir. Yes. Okay, so just to repeat, the website you should use is warrants.com.sg, free of charge, where we tell you everything about warrant. So warrants.com.sg, the homepage looks like this. Hansi, can you click on the logo? Yeah, the homepage looks like this. So for example, we tell you there's a cash rebate now. In order to access any of the tools, you can go to Warrant Tool dropdown. Okay, the selector is the second one. But as long as you are in the page, an internal page for any of the warrants, so you can go to warrant search also, of course, then you can see our full list. We've got warrants over DBS, UOB, whatever. But from the selector, if you have used it, okay, you click on any of the warrants, it's going to take you, once you go to select underline. Anyone, you call put, doesn't matter. You click on any of the warrants, it's going to take you into the internal page of the warrant where it tells you what the line matrix is, the exposure simulator. We even have a calculator to tell you the approximate date that you can get out of, right? And then historically how the warrant has performed. Okay, so you just need to click into the warrant and then it's going to give you everything you need. All right, on your way home, if whatever I've said is not enough for you, we are also on YouTube because everybody wants to be on YouTube these days, right? Like this one is live on YouTube, isn't it? You can go to Warrant Education. You can go to the 1-minute video, or here you can click through. Educational 1-minute video. Actually, scroll down, you can see, yeah, you've got, like, we tell you what warrants are. Sorry, it's me still. But I also ask my colleague to, so you don't always have to hear from me. Common questions like, do I get dividends if I bought a warrant? What happens when there's corporate action, like DBS, a lot of corporate action, like what bonus, like share buyback, all these. What happens? I mean, we'll tell you there. Okay? On your way home on the train, it's only 1 minute. Any other questions? Yes, sir. Huan Zi.
Yep. Okay. Correct. Okay, so the USD strength likelihood will continue to weaken, and in that retrospect, you correspond it to the HKD strength. Definitely, there should be a downtrend, weakening Hong Kong dollar, especially when China is also trying to tackle the inflation from imports in terms of the tariff impact. So, of course, internally, they have, like I mentioned just now earlier part, their inflation is low, right? Deflationary in China, slight normal inflation in Hong Kong. But the issue is that there's a lot of input cost increase out of nowhere for China due to tariff. So one of the ways that they do is to devalue, right, their currency, right, to actually make it cheaper for their products to sell overseas. Right? You know what I mean, right? Because when the China yuan gets cheaper, people buy your product at a cheaper cost. So people will buy from you, right? So they want to sell the product, right? Of course, then the cost of input to them is higher. But a lot of times for China, their input raw materials is themselves, right? They don't really buy that much raw materials from overseas, except for specific components itself. But it's a net overall in terms of how China handles the impact of tariff. Generally, devaluing have proven to work better than not for them. So likelihood they will continue or let it run. They won't say intentionally devalue because that's also not what they want to uphold, right? When US is actually making themselves a bit less relevant in international scene, China want to be more relevant. But they also do not want to make it costly for themselves to be relevant. So they won't defend the currency as much as previously. based on the current trend. So in a sense, USD can continue to drop. USD might, in the short term, push against Sing dollar back down to 126, 125 levels. Right now it's I think 1288 or 1289 area if you're following USD. All right. So I think in terms of currency, I'm not a currency expert per se. That's more of Nova, Phillip Nova, our sister brand. But in general, USD depreciating is confirm the case because you can see already the treasury's been selling off. There's fund flow out of US selling USD to go to other currency safe havens like Japan and others, even Singapore dollars. All right, and in that sense, then HKD will drop. So yes, HKD stock performance might be good for Singaporeans investors, like share price go up, but your currency in terms of the holding as a portfolio might have a suffer a currency correction impact. So let's say a 8% up in portfolio might have only a 6% up net effect to Singapore dollars is possible, right, due to the currency impact. But that's why sometimes if you're looking at a short-term range movement, right, that's where warrants come to play. But warrants don't have that much of an impact in terms of currency. They have a more subdued impact of currency due to the fact that they are a structured product. They are also impact the same way in terms of the currency, but not as the same leverage ratio extent. So in a sense, you get a better return profile on the leverage products than on the stock itself. But that means that you also take more risk. That's why you must be handling the ratio, which what Jamie mentioned, of your ratio of the portfolio of shares versus the number of warrants that you purchase, the number of exposure you get for yourself. So that's the main thing. So I hope I answered the question. So in my view, it's going down, yeah, for currency, but the stock should be uptrend. For Sing Hong Kong, to be fair, it might not move the same way. Singapore MAS does not really control the currency in that linear manner. We do not let it run as per market movement. So if you follow Singapore ways, we do hold a basket, and in the basket, we do not hold in terms of the same ratio. So not saying that USD will drop against the world and HKD is pegged against USD doesn't mean that we will have to move in the same impact direction. There can be a slight buffer impact between us and US and us and Hong Kong. Singapore is able to hit that type of scale. Of course, the general trend will still be down, but there might be a less impact in terms of HKD in movement than Singapore. And actually, US HKD, I do see that when China is starting to sell US Treasury, Hong Kong can actually eventually depeg effectively from US. It's just whether China want to do it. You know what I mean? Then China have the ability to depeg Hong Kong now with their selling off of US Treasuries. They're not as reliant in terms of the Treasury's strength, impact to the financial stability of Hong Kong. No longer, they have enough gold reserve to hold Hong Kong stable. But China, of course, does not want to shift or swing the currency or the region in the short term. So likelihood they will not do anything for a short run. But eventually, I do not see Hong Kong pegging as strong to US if this continues lah, if the sell-off continue. Yeah. And China do really bought a lot of gold compared to the US Treasury. It's in correlation. They bought more gold than what they sold off in treasuries. So there's a lot more room to what China can potentially do. Yeah. Okay, so I think we have ran quite a long while, slightly overrun. We do have upcoming other events that we have, right? If you're interested in gold itself, we have the event tomorrow. If you're interested in the warrants again for more sessions, we do have another session upcoming potentially. All right, and then you can just look out for sessions that we have on our education page on the poems.com.sg and also other products if you're interested. All right, so thanks everyone for joining us today. I hope it was insightful for you. Yep. Right, thanks everyone that joined both physically and on online Zoom. Thank you.